Good morning, everyone. Welcome to our annual fund review presentation. The fund which we'll be discussing today is our local balance fund, which is Regulation 28 compliant. Welcome to everyone attending our inaugural breakfast here in office and also those dialing in. Just a quick introduction. I'm sure you are mainly aware of who we are, but my name is Ross Beckley. I'm the Chief Investment Officer here at High Street Asset Management and also the fund manager on the local balance fund, which we'll be chatting about today. To my direct left, Charlie de la Pasteur. He's the lead analyst on the Wealth Warriors Fund. Wealth Warriors is a very significant portion of this fund, so it is crucial that we get some background and some insights over there. To his left, Christopher Brownlee, who is the head of research and the lead analyst on the local balance fund. Let's dive right into things. Just looking at the performance that you saw across markets last year, it was a very nice recovery from the difficult markets that we saw in 2022, primarily offshore. If you cast your mind back, you'll remember that the offshore markets performed poorly in rands, delivering about negative 15% return relative to the all share, which was up slightly. Those fortunes did reverse very strongly into 2023. The reasons why we'll go over a little bit later. But looking at the charts on the left, you can see the JSE all share did a respectable 9.4%. However, looking at the developed property index, 17.6%. The MSCI World, which is the equity index, 33.4% in rands. And that gets even more nuanced as you look into the United States, with the S&P doing 35.3%, largely driven by the Magnificent Seven, which we'll go over later. Finally, onto the local balance fund. We do like to benchmark ourselves against a global index, as that is what we are trying to offer investors, or at least retirement savers, especially here in South Africa, is a globalized, global-like fund that's denominated in rands and is compliant with Regulation 28 of the Pensions Fund Act. So we outperformed that global benchmark very nicely, delivering 48.9% in rands, significantly above the all-share index as well. If we look across to the right-hand side, how did the rand perform against major currencies? We can see that the rand was weaker across the board, and there was a good showing from the pound sterling during the year. Just a reminder of what we do here at High Street, and in particular this fund. We are offshore specialists. We try and cater to South Africans looking to diversify their wealth internationally. This fund in particular is our most differentiated, is arguably our most differentiated offering. We seek to maximize offshore exposure and minimize South African risk within the bounds of Regulation 28, which is part of the Pensions Fund Act. How do we do that? We always utilize maximize our direct offshore allowance, which is currently at 45%, and that aligns with the current direct offshore exposure of the fund. Then with the local component of the fund, which is the remaining 55%, we aim to maximize the rand hedge or foreign derived revenue streams, and once again minimize SA specific risk. So we'll hold many of the large dual listed companies, the likes of Anheuser-Busch or a Glencore. And we'll also hold smaller companies, which we as a boutique are able to invest in, as we are quite nimble and size is not that much of a factor at this stage. The likes of a Master Drilling, with the majority of the revenue linked to the US dollar or derived directly in US dollars. So what is the result? The result is a retirement offering with a current 97% rand hedge bias. We are yet to come across anything in the market, and that is the unique selling proposition of this fund. Just having a look into a few hard numbers to substantiate the reasoning behind the fund mandate. First of all, the graph on the left shows the rand versus the US dollar going back to 1995 since democracy. We can see that the rand has depreciated on average 5.7% per annum against the US dollar. You will notice during risk off, during times of panic, of market panic, the rand can blow out significantly. However, it generally comes back to that trend line, which you can see over there, which is the inflation rate, which is explained by the inflation rate differential between the two countries. So we are not economists, and we don't try and forecast these things, especially in the short term. We ask clients to make up their own mind, but we'll offer a product that benefits should the rand continue to depreciate at these levels against the dollar and other major currencies. Looking at the market performance on the right, in orange is the S&P 500. You'll see that it's really diverged from the JSE All-Share Index in navy blue since about 2011, 2012, so over the past decade. There's been a factor of two things. I think both the economic growth in South Africa has been very muted over the past decade. Once again, we don't take a view on where that's going, but all indications at this stage, we are still going through very tough economic conditions. Contrast that to what's happening in the United States, and the economy is performing very, very nicely. Currently, they're near all-time lows of unemployment. Wage increases are coming nicely, and the economy is growing at a steady pace, albeit there is a fair degree of inflation around at these levels, which is a key determinant in the pricing of securities, which we'll touch on a bit later. However, to conclude there, I think the performance of the S&P 500 at done 4,665% relative to the all-share at 1,408%. Just vindicates the mandate of the fund, and we expect the US to continue performing nicely. Most importantly, how does this all translate for you, our investors? Since the fund was launched at the back end of 2018, it's done just about 15% per annum, whereas the benchmark has done about 9% per annum. So significant outperformance there. Looking at the orange rectangle to the right, that is the 2023 calendar year. As mentioned on the previous slide, we did 48.9%. And with that return, we are the top performing fund in a CISA category over that period, as well as for the period dating 5 years back. So we are very happy with that performance, especially with the difficult conditions that we saw in 2022. We have bounced back nicely, and we are at new all-time highs. Important to note there is that the fund's outperformance of the benchmark came despite the rand only depreciating by about 5.5% relative to the US dollar, which is actually less than its long-term average. So we are more than just a one-trick. We believe we are more than just a one-trick pony, and not only dependent on a weak rand to generate fund performance.
Ross, do you want questions at the end?
Yeah, let's have it to the end just for the people online. Thanks, Carl. Looking at the asset allocation, in line with the fund mandate, we sought to increase our offshore exposure. We sought to increase our offshore exposure. However, Regulation 28 limits, the Regulation 28 Act allows us 1 year to rebalance the fund. So should we go over those limits, as we did last year, due to a strong dollar and strong performance of offshore markets, that increased the direct offshore component of the fund, which we needed to rebalance going into 2023. That said, we did keep it at the maximum limit at 45%, which proved to generate significant returns for the fund on the back of those strong offshore markets. Looking at the charts on the left, I think what stands out to me is our position in commodities. Going into the year, we had a 0% exposure, and going out just about 4% exposure. This was due to initiating a position in the new gold ETF, which is a nice diversification to a balanced fund. But moving forward, we aim to always have maximum offshore exposure and maximum equity exposure as well. So that was the asset allocation. How did it feed through to fund performance? Firstly, we can see the Rand hedge equity component of the fund. This accounts for about 50% of the fund. The component as a whole returned 20%. However, when factoring in the weight that this segment has in the fund, it contributed 6.4%. Moving across to the offshore equity, this was the darling of the year. It generated or added an incremental 33.3% to fund performance. And when accounting for the fact that we had about 45 to 50% offshore, this meant that that segment on a gross basis generated a return of 83% in rands, which is very, very impressive. That said, it was off a low base going into 2023, which we'll touch on a little bit later. The Rand hedge property counters continued to perform very well, delivering 8.2% to fund performance. And bearing in mind that only 18% of the fund is invested in Rand hedge property, that segment as a whole did an impressive 40% over the year. Offshore property contributed marginally, and then the other expense which you see there, those are trading costs and fund expenses, etc. So all of that culminated in a return of 48.9%. Let's draw your eyes back to the offshore equity component. I think it is important to get some clarity over on that, so I'll hand over to Charlie.
So I'm sure most of you, if not all of you, are familiar with Wealth Warriors and what we try to do at High Street in our global equity fund. But just in case, I'll give a sort of brief overview of what it is. The mandate is central to all our funds at High Street, and it really dictates the investment making decision process for that particular fund. Wealth Warriors, or the local balance fund, has currently a 23% exposure to Wealth Warriors. It's important to note that the High Street doesn't charge double fees on that investment, but it makes up the majority of High Street's or the local balance fund's offshore exposure. It is a global equity fund, so US dollar denominated, offshore focused, and it invests across select developed and select emerging markets. It does aim to provide long-term capital growth. So we do recommend a 5-year investment period due to a slightly more aggressive risk profile. You will see on the next slide with the performance just why we recommend that investment horizon. And then finally, themes, or it uses a top-down thematic approach. We look to identify investments based on advancing technological innovation and changing consumer behavior. So these are the themes that are essentially driving the world forwards, advancing technological innovation. So cloud computing, cybersecurity, artificial intelligence, all these themes that you read about, and essentially are featuring massive growth at the moment. So fund performance since inception in 2017, in the blue line you have Wealth Warriors. You can see a great performer and significantly outperforming its benchmark, the MSCI World Index, up until 2022. So naturally, COVID in 2020, or back end of 2020, or back end of 2019, beginning of 2020, it creates a lot of issues for us personally, and naturally that then filtered through to the market. So lockdowns prompted the disruption of supply chains and the addition of a massive amount of fiscal support stimulus, which naturally led to higher inflation. To combat, you rise interest rates, and that naturally hurts equity valuations. We did sort of in our call last year say that companies were performing well regardless of the sort of depressed share prices. and then when an inflationary environment sort of normalized once more, things would bounce back. So luckily and thankfully, it happened sort of fairly quickly. And so you can see in the blue block in 2023, the fund returned 74% in dollars against its benchmark 22%. Which leads Wealth Royals to overtaking its benchmark at 118% since its inception versus the benchmark 102. We do see significant upside still from this fund. You can see sort of just to the right of the blue line, this is performance so far this year, and it's very much maintained its trajectory. And we do see still a lot of upside based on our highway valuation models. So unfortunately, we don't have time to speak too much to Wealth Royals today, but we thought it'd be worth just highlighting the top performer in the fund, which is NVIDIA. It is a significant weight. It started the year in 2023 at about 4% weight, and through just organic growth, it now stands at around 10%. Earnings are out for NVIDIA on Wednesday, which is a big moment for us across high street funds. Bit of background on NVIDIA. They invented the GPU, the graphics processing unit, in 1999. This was a significant upgrade, you could say, to the CPU invented by Intel in 1970. The CPU is very good at sort of general computing. What the GPU did was it specifically was created to crunch a lot of data very, very quickly. So that was very popular with gamers. Originally, GPUs were exclusively used in gaming. That then moved on to Bitcoin mining, the sort of large algorithmic number crunching needed to mine the blocks. And then now it's been moved to AI. And data centers around the world and big cloud providers, you can see on the left-hand side, the names you'll be very familiar with, Amazon, Google, Alphabet, Microsoft, and Meta have been buying these chips up hand over fist. A single chip can go as much as $30,000, and it's just been an enormous race to get this technology. So NVIDIA now supplies the hardware powering the AI technological revolution, and this phase has really only just started. So share price rose an extraordinary amount in 2023, 263%. However, this was on the back of solid fundamentals. So at High Street, we don't look for just themes and exciting ideas. We look for numbers and hard fundamentals to back up our investment case. So you can see just a few stats there from the third quarter results. Revenue growing 206%. In data center alone, it grew 171%. Net income surging 1,200%, with net profit margins rising above 50%. So the sort of irony of this is, despite terrific performance in 2023, when you look at it on a valuation basis, it actually became cheaper on a forward PE multiple, which really sort of speaks to the fact that investing in solid companies over the long term, they can grow into their valuations if strong fundamental performance follows. And that's what we try and do within Wealth Warriors and High Street in general.
Okay, just to break down the top equity performers, obviously we've spoken to Wealth Warriors, just on an individual basis. Other than Wealth Warriors, we choose our equity names from our best ideas amongst our other funds. Speaking to the offshore equity there, you can see CrowdStrike had a very good year, up 160%. CrowdStrike is a US cybersecurity company, although they do have multinational operations. But yeah, they were the first mover in using AI and AI depositories to detect these cybersecurity threats and then respond to them. It's a very strong year for them there. Meta was also very strong, a core holding in the fund, up 250%. Fundamentally, it was a very, very strong year for Meta. Mark Zuckerberg named it the year of efficiency. He went on a cost-cutting rampage. He cut over 25% of the employee headcount. And as a result, costs came down massively. And as you would imagine, the profit margins inflated. Based on the last quarter, the Q4, revenue grew 25%. So a very nice return to growth for Meta, which we saw throughout the year. And their operating profit margin actually doubled from around 20% to 41%. And as you can imagine, profits or net profit also doubled. And for the first time, Meta actually announced that they will be paying a dividend for the first time in the country, in the company's history. So yeah, a big positive statement from management. And then I think importantly, as Charlie mentioned, these companies do grow into their multiples. Despite that 200% or so growth in 2023, Meta is still trading on a forward PE ratio of 22 times, which we believe is reasonably cheap considering that it's a high margin, high growth company. And then, yeah, of course, the top performer, Nvidia, 263%, which Charlie did speak to. Then looking to our RAND hedge names, you got Mondi. I think we all know the business, paper and packaging company. They are our top pick within the space. They have a very integrated asset base, and they're one of the lowest cost producers in the sector, which allows them to have sector leading margins. As a result, their returns on capital is very good. Management has a history of very strong execution. Their capital allocation has been great, and yeah, we also like the fact that they are very highly levered to packaging. So 70% of their revenue comes from packaging, which obviously has natural tailwinds from e-commerce and e-commerce delivery growth, etc. Then Bidcorp is also a very strong performer, returning 32% in the year. Yeah, obviously Bidcorp spun out of Bidvest in around 2016, and we've been invested the last 2 or 3 years or so. Yeah, very multinationally diversified business with the lion's share of its revenue coming from developed markets, and really does fit the RAND hedge element well, with less than 4% of its revenue coming from South Africa. And then the top performer from our RAND hedge component was Renet Investments, 45% return, but I will go into that in the next slide. So just to focus on Renet a bit, I think not many people are aware exactly what this business entails, but it was established in 2008 as an investment vehicle after Richemont restructured, so that there would be a split between its interest in BATS and then obviously the luxury goods business. Since then, Renet has been actively diversifying its holding, and BATS now makes up around 25% of the NAV, whereas when it first listed, it was around 90%. The big hidden gem here is its 49.5% stake in Pension Insurance Corp, Pens Corp, which is a niche financial services company based in the UK. Just a little bit of background on Pens Corp. It is quite a complex business, but basically it's a pension risk transfer business, which is focused on defined benefit pension funds. So the company, what they'll do is that they'll remove the pension liability from companies that are still using these more legacy defined benefit pension schemes. And they'll do this in 2 ways. They'll either do what's called a pension buy-in, which is when they insure that pension scheme directly, or pension buyout, which is when the pension sells the assets and liabilities along with the underlying scheme members to Pens Corp, obviously at a price, and then Pens Corp then manages those assets and liabilities. Important here is it's a very complex industry. As you can imagine, there's huge scale, regulatory skills and capital barriers to entry, and as a result, there are very few players within the UK market. However, it is a very, very large market, and there's massive growth opportunities here, especially in the UK. Pens Corp management have come out saying that they estimate the market for the UK market for defined benefit pension schemes that are looking to transact to be at around £600 billion, and their own pipeline to be at around £50 billion. And if you consider their current portfolio is sitting at around £45 billion, there is a long sort of road for growth there over the coming years. Yeah, so Pens Corp is considered one of the Rupert family's most successful investments, and makes up over 50% of Renet's NAV, which we really like to see. That percentage has been growing massively over the last few years. Also, what's encouraging is in the past, Renet used to just track BATS price quite closely. However, in the last 2-3 years, the real driver of performance has been Pension Insurance Corp, which is a business where what we really are positive about. And in terms of the discount, we know these holding companies do tend to trade at a discount. It's normally between 10 to 20%, obviously depending on the company. However, Renet is currently trading at a 42% discount to NAV. What is encouraging, that has been coming down over the last few years. It was as high as 54% just a year and a half ago. So yeah, over the long run, we do believe that that discount will start to close, and as a result of that unlock, there will be some upside, and that, along with the growth in pension insurance corp, is the real driving reason behind our ownership of the share. So we're very happy holders, and yeah, very positive return in 2023. Then just speaking to our worst equity performers, very encouraging to see there were no major drawdowns in 2023 across our equity holdings. On an offshore component, Elevance was the only holding that finished in the red, slightly down 0.2%. And then yeah, you'll see United Healthcare there up 8%. Elevance and United Healthcare are both US health insurers, actually the two biggest health insurers in the US. So you can imagine these are very defensive businesses, highly cash generative, and you're able to produce robust earnings growth even in the hardest of economic environments. And yeah, while the return wasn't stellar, they served their purpose. You can imagine that in a risk-on environment, these type of more defensive companies will lag the growth equities. And yeah, very similar case with Merck, US pharmaceutical major, also producing around an 8% return. Looking at the Rand edged equity, on the downside, we had SAPI down 6%. SAPI is on our list to review. We're not quite as positive on them as Mondi. Firstly, they are quite exposed to the graphics paper, so office paper, and you can imagine the tailwinds there aren't great with people working from home more, and yeah, people just in general using less paper. However, from a valuation perspective, it is very, very attractive. Trading at extremely depressed multiples, and yeah, management has been quite effective at reducing their debt load over the last few years. Then Master Drilling, also one of our highest conviction stocks within our Rand hedge universe. Very unique business. They basically provide the boring and drilling equipment for miners across the world. So they're diversified across both commodities and geographies. And as Ross mentioned, the vast majority of their revenue is tied to dollars. We also do think there'll be a natural beneficiary of this move. So in the last 12 or 15 years, there's been a severe underinvestment by these large miners into capex, growth capex in particular. However, in the last year or so, there's been many indications that that growth capex and spending is going to start to come back as they reinvest in growth to sort of provide these materials for the green transition. So yeah, fundamentally that stands Master Drilling in good stead. And then yeah, we all know Processor a return of 4% up there. Okay, just to speak briefly to our property performance, I'm not going to go mention all these names. Yeah, very, very good showing across the board, except Match Real Estate. That drawdown came mainly in September, where the stock was down about 25% after management cut their dividend for that half of the year. Yeah, basically just stating liquidity constraints. And while the stock did sell off quite sharply, we saw this actually as an opportunity to add to our position. Firstly, the insiders, the main insiders in the company were buying the stock hand over fist. And yeah, in our view, in the current interest rate environment, it is actually more prudent to rather cut your dividend and pay back your loans with that saved and retained earnings, as opposed to issuing more debt at these elevated interest rates. Then industrial REIT, quite an interesting one there. It was also one of our favorite picks within the sector. We say unfortunately, but it was at a 42% premium. They got acquired by Blackstone, the US private equity company. So yeah, that is obviously where most gain was realized. But yeah, just speaking to the value they see, Blackstone sees in this multi-let industrial space where the majority of our investments lie. And then Cirrus Real Estate is our highest conviction pick in the property sector across all our funds. We've had a relationship with management over many years. They're extremely efficient operators. They've been able to increase their rentals well in excess of inflation, which has allowed them to grow their funds from operation, and as a result, increase their dividends consistently. The dividends have grown at almost 20% over the last 5 years. That's per year. So yeah, and that has really been driving the share price performance we've seen.
So at High Street, we mostly look at the fundamentals. We don't spend too much time on the macro. However, it is good to be cognizant of where we are, especially at extremes. So we prefer not to forecast. We prefer to position on the back of sharp movements. Speaking about sharp movements, we saw CPI really accelerating to almost to double digits through 2022, and we went into last year with inflation rates just starting to tick down. However, still at very, very elevated levels. So I did have very sweaty palms sitting here last year, but I think for once the macroeconomists got their forecasts correct. And the dotted lines which you see on that chart now for the 2024 calendar year and moving forward actually projected the same downturn that we actually saw in inflation prints last year. So inflation continued to come down from significant levels at a steady pace, and as such, we saw interest rate hikes from the Fed peaking and arguably have topped at this stage. Interest rates are the bedrock of valuing financial securities, all the way from a cash account when you receive your daily interest from the bank across to bonds, very closely correlated to interest rates, and then to property and equity. In equity, where it's the major factor is it's used as the discount rate in coming to a present value of future profits for that company. So you can imagine that high growth companies that have a lot of their earnings, let's say 3, 4, 5 years out and beyond, are very sensitive to changes in interest rates. So where do we stand today? Interest rates are still at an elevated level, just about around 5% in the United States. And I think the Fed is well aware that they simply cannot afford for rates to stay up for too much longer. Governments across the world are very heavily indebted, and with interest rates picking up and governments having to roll their debt or reissue their debt as it matures, at these rates of financing, they simply cannot afford it and will become insolvent at a stage. So the Fed's aware of that. As such, we've seen interest rates, or at least the outlook for interest rates cuts moderate. And now most market participants are only seeing the first cuts in the US come June of this year. Previously, it was for cuts as early as February. So inflation is still around. It is something that we need to be well aware of. However, we did show charts last year showing market performance given elevated levels of inflation or giving in rising interest rate environments, and the markets actually shrugged that off and to continue to perform quite nicely over 1, 3, and 5 year periods, as we have seen this year. So how does the macro translate into share price movements? It's a very busy chart over here, and we have spoken to it quite often. However, I think it's very important just to spend some more time here. For the graph on the left in orange, we've got the MSCI Growth Index. You can see that it has outperformed the value index considerably over the past decade, the value index being the line in blue over there. However, with that outperformance comes a large degree of volatility. As mentioned on the previous slide, that is a factor of interest rates, and with interest rates moving around considerably over the past 2 to 3 years, the volatility is there for all to see. So the drawdown which we saw in 2022 in that orange block over there was the result of a rapid increase in interest rates in an attempt to tame inflation. Charlie spoke about how we tried to look through that. We try and look at the fundamentals. And what we said going into the back of last year was that fundamentals had remained resilient and companies were delivering on their revenue targets and revenue and margin targets. So what have we seen? What did we see last year? Last year we saw a complete reversal of that. Markets were anticipating inflation and subsequently interest rates to come down, as they are still expecting to take place later this year, which saw a recovery in those growth names. So the fundamentals remain unchanged. However, there was a significant price movement which impacted the value of these shares. So where are we today? We coincidentally at the same place that we were when we were speaking last year. So growth has recovered all of those losses. However, what do we see going forward? Moving forward, interesting enough, our highway model, our investment process, forecast value, the average value share to perform roughly in line with the average growth share. I think that's very important to state that we don't have a preference for growth over value at this stage. However, when looking at the index composition, some 20% of the MSCI World Equity Index is made up by the Magnificent Seven, that being Nvidia, Meta, Microsoft, and the like. So these big tech shares, the performance of these 7 shares are very instrumental in the direction of the markets, which we are going to see over the coming year. And looking at these individual shares, our model suggests that there is significant upside above average across these names. So we expect that while the market breadth may expand and may not be driven solely by these Magnificent Seven counters, we expect that they will continue to dominate the headlines, as they are such a large factor of the index, and we expect them to continue their resilient performance. So Chris can speak a little bit more about the fundamentals.
Okay, so ultimately fundamentals is what drive our whole sort of research process and our investment processes. As Ross referred to, in 2022, we decided to remain invested in our growth holdings. The fundamentals were largely unchanged, remained robust following the 2022 rate hikes, and as a result, we did stay invested. Fast forward a year, these fundamentals are still attractive, despite a very strong recovery in 2023. We do believe there's still upside in select growth names, and of course, select value names as well. But just a sort of snapshot of these fundamentals. This is a weighted basis of these various metrics for our Rand hedge holdings versus the JSE All Share, and then our offshore holdings versus the S&P 500 index. So firstly, return on capital. This is basically just the profit you earn on your capital base, being equity and debt. And yeah, there's a long sort of said investment term that a company can't, in the longer run, earn a return in excess of the return that a stock can't earn a return in excess of the return that the underlying business earns, being the return on capital. So basically, if you hold the stock for 40 years and that stock earns a 6% return on capital per year, you're not going to earn a return much in excess of that 6% return per year, even if you buy that stock at a huge discount initially. So yeah, return on capital is a large driving force behind stock price performance, and very nice to see their Rand hedge return on capital of almost 15%, double that of the JSE All Share, and then from an offshore perspective, very, very strong. This is largely due, as Ross mentioned, those big tech companies where we still see value, Nvidia, Meta, Microsoft, etc. They're operating at margins of sort of 40% plus, and that really does boost your return on capital. And obviously, all growth on a higher margin is highly accretive. And yeah, that does dwarf the S&P 500 index of 8%. Then growth, also a large driver of share price performance. You can see there, Rand hedge growing 6.5% over, that's per annum over the next 5 years forecast, dwarfing that of the JSE at 1.4%. Then the offshore growing around 14% versus the 4.4% expected for the S&P 500. Profit margin, our Rand hedge holding are slightly below the JSE. However, we're not too unhappy with that given the superior growth. And then on the offshore perspective, 17% plays 12%. And then just lastly, on valuation, this is our 5-year IR, our core valuation metric. we see our Rand hedge holdings producing around a 15% return per annum for the next 5 years versus our offshore producing around a 21% return after the next 5 years. So the fundamentals are strong, and especially versus the various comparative indexes. A very similar exercise except properties, but obviously comparing property-related metrics. Our property holdings do continue to benefit from the stronger fundamentals due to the geographies they operate in versus South African operators. Loan to value, basically the leverage of these property companies, is quite similar. Our Rand hedge 37, offshore holdings 40, and SA listed property 27. But very importantly is your average cost of debt. What cost are you paying on your debt that you have outstanding? So the Rand hedge is around 2.9%, offshore 2.1%, and versus the SA listed property index average of 8.3%. You can imagine just how those debt costs do weigh on the company's operating profits and cash flow produced. Then in terms of the ability to cover debt, far superior interest coverage for Rand hedging offshore, and basically this allows for superior profit generation and as a result superior dividend growth, which you can see there with the 5-year analyzed dividend growth for our Rand hedge and offshore holdings quite nice and strong there versus the SA listed property. Actually dividends been declining over the last 5 years or so. Just to conclude, we do believe we have a differentiated offering here in the retirement space. Our performance has been very strong over the last 5 years since its inception. We are recently available across most major platforms. We spent a lot of time and effort on that last year. And year to date, the strong performance of 2023 has continued. As of yesterday, the fund is up 6.6% for 2024. That's versus quite a weak JSE of down 4%, and that is boosted by the Rand appreciating by 2.8%. In terms of our benchmark, the peer average, we only get that data on a monthly basis, but for the month of Jan, it was down about half a percentage point or so. So a good start to the year, and good to see the continued strong performance from 2023.
So I hope we provided a bit of valuable insight there. And we open the floor for questions. And you still got your questions?
I'm on the well done, guys. Fantastic. I just something that concerns me, and it shouldn't, but having listened to everything you explained, your processes well, and that I just having performed so well last year, you almost want to think that should take some bets off the table to sustain those sort of things. I know all those things look solid, but having looked at 2022, so I was showing a FD of a company, your performance the other day versus like Ellen Gray, and you guys have outperformed them handsomely. But in 2022, your bets must have been higher, or you probably had smaller or bigger holdings in smaller companies, which made you more volatile. So just talking to like an FD of a company who is traditionally risk averse for his investors, saying, hey, then they're sitting and say, Ellen Gray does, which is quintessentially solid but boring, and saying, hey, have a go here. It says, well, 2022 was a bad year. It was a very good year. Probably chance of another bad year. I just wanted how to sort of talk around those things. It just, I know there's lots of research where guys have chased unit trusts over the years and bought last year's winner.
Yeah.
And they always lose. You buy last year's loser, and you think that some of the bets have been bad, that were bad last year, are going to come good this year.
Yes.
Whereas yours all look like they came good. And so, it's just fantastic, but one must worry that there must be some inherent risk in having done so well.
Yeah, so I think I can answer that by referring you to the performance chart there. Going into the 2022 financial year, the fund was once again one of the top performers in the category over 3 years. And then all of a sudden, interest rates rose significantly in the States, and we saw fund performance deteriorate significantly. All of those losses endured during that year have been caught up during 2023, and then just a little bit. So it either means once again, it's very similar to that previous slide. We've been completely whipsawed by interest rates going up and down, but we're still in the same place when you look at the level of the growth index. So it comes down to how did we see valuations 2 years ago, going into that dip that we saw in 2022? And we thought valuations at that stage still offered significant upside. However, interest rates dampened valuations despite the fundamentals coming through, but that's reverted. So we are in basically the exact same position that we were going into 2022, and we still believe that valuations are compelling at these levels. Our IRR is just an internal metric, and we, outside investors mustn't attach any guarantees to those numbers. However, those numbers are still predicting very good returns from the offshore component, especially. Charlie mentioned NVIDIA performing very, very nicely and growing into its valuation very quickly. And if you look at it on a forward basis, it's on a forward PE of 30 times.
Even like 25, yeah.
Of 25 times, which is currently growing earnings at what, 50-70%. So that's a very basic sort of traditional metric that we look at, and that indicates that the market is not that expensive. Likewise with the Meta is on a 22 forward times PE ratio, and all of those big tech companies, if you look at them on a forward basis, they don't look that expensive. So it is a concern, and especially if interest rates were to rise again. So let's say inflation was left to its own devices and picked up, and interest rates subsequently picked up. I think we'll see much of the same reaction that we saw there. However, looking at the fundamentals over a 5-year period, our models indicate that there is 10 to 15% plus in rand terms to come.
Carl, sorry, I think that's the important point, is that 22 was, you could call it an aberration in terms of how central banks globally had to respond to the threat of inflation. And I'm sure you see in the charts, it was one of the most, if not the most dramatic increase in interest rates. I mean, the United States basically went from 0 to 5.5% in a matter of months. Now, that has a massive distorting effect on the valuation, particularly of growth companies. And as Ross and the team have shown you, we do have a natural bias towards growth because we think that over time, that's where the most upside comes from. It does mean that where you get these huge volatility impacts, we are going to be impacted by that. Is it going to happen again? Who knows? We don't think so, because we've shown you where we think the trend of interest rates is going. But the extreme volatility that CFO picked up on is without doubt due to, in large part, the increase in interest rates. There's a second factor, which we haven't spoken to, which is we did have an exposure to China, okay, across both the balance fund and also wealth warriors. Now, that's a story in and of itself. As we are today, we have zero exposure to China, other than through global multinational businesses which have operations in the country. We took a decision as a house that there was so much frustration that we had with what was going on the ground there that we decided to exit the country completely. And I think that we've been vindicated, if I might say, by what's transpiring at the moment in terms of them trying to address the economic situation that they find themselves in. But I think the answer for the CFO can really be ascribed to that rapid increase in interest rates, which quite frankly was unprecedented. It was an aberration.
And possibly to balance that, you back some other investors who've got a more value-oriented bias, and that might take some volatility out. I mean, I'm talking particularly on a provident fund where guys retire. And a guy, has to retire and he doesn't want to be down 20%.
No.
So you've got to sort of try and mitigate it somehow. So is a reasonable answer that you guys are probably more growth oriented, and that makes it slightly more volatile. potentially better performing, that's like more volatile?
I'm not so sure. I'm not so sure that it's necessarily more volatile. I mean, we've run lots of analysis around this, and we can share that with you.
Yeah, so because it is a global like fund denominated in rands, if hypothetically if you actually convert the performance figure of the local balance fund into a dollar return and convert the performance of our benchmark, our peers, into a dollar return, we are in fact less volatile than our peers, which makes sense because that's what we are aiming to achieve for investors. On the whole growth versus value debate, as a house, we are style agnostic. We are just currently overweight the growth theme because we see more potential upside in those names. However, what we've done over time, over the past, I'll say year and a half, is we've slowly reduced our exposure to these growth names and we've invested in the value names. For example, Chris spoke about United Health and Elevance. They were pretty flat last year, but you saw some extraordinary performance from likes of an Nvidia, a Meta, etc. We have taken some off the top and we've started to rebalance the portfolio. But for someone nearing retirement who is going to need to draw on their investment, I agree 100%. The rand alone makes this a volatile investment for someone nearing retirement who needs rands. So I would look to balance it with less volatile investments.
Because Scott, you can see, in that chart, because we're rand hedged, naturally the volatility of the rand impacts the valuation of the fund more so than it would if it was a rand long rand. But second, I think just to sort of conclude, you can't look at 2023 in isolation. Because we've been living through such extraordinary times over the last 2 years, 22 and 23 are inextricably linked in that the massive drawdown and the massive recovery should be looked at rather as one period rather than a sort of calendar year.
And we're back to where we started. And we still believe that valuation.
But we understand the issue, Carl. We understand it. And I think that it's the first thing that one would pick out if one were to be looking at the fund saying, well, hang on, really good year 23, but Jesus, what happened 22? So hopefully we can give some context around or offer an explanation as to how one got there.
Okay.
And speaking to the rand and how that affects fund performance, I did mention since inception the rand has depreciated about 5.5% per annum, which is actually less than its long-term historical average, and we still managed to generate significant alpha. If the rand was to strengthen to the 1817 mark, what would you expect from the fund? In a theoretical world, if the rand would be to strengthen to 1817, it would be indicative of a risk-on environment, in which case we would expect our offshore names within the fund, the likes of Nvidia and Meta, to perform very well in that risk-on environment. So that will largely dampen the negative effects seen from a strengthening rand. It will be dampened by the move in those offshore names. However, if you believe that the rand is going to go to 15, 14, 13, then I'm pretty certain that we will begin to underperform our peers.
But we don't have a view on that.
Okay, my last question. One doesn't want to take advantage of the world's current woes, but it would appear that defense stocks are going to keep growing. The world war's going to be going on for the next few years. You guys have got a view on that?
We do. We actually held some defense stocks in another product of ours, and they performed very nicely. We subsequently had to sell out of them because
it was an ESG concern.
ESG has it.
The sort of the Central Bank of Ireland, who are sort of overall regulators, decided that sort of the ESG methodology didn't agree with weapons. Similarly, they don't agree with cannabis. They don't agree with other, other select industries. So,
but that said, we do think that they are going to be significant beneficiaries, not only from the war, but they've also got other aspects of their business which are performing very nicely, such as aircraft, etc.
Satellites. space.
Correct. So it's not just artillery which they're sending to war, but we speak about strategic assets. And we think these defense assets are very strategic to the United States. You would have heard about the rare earth metals and the trade wars that were going on between China and the US in securing capacity. These rare earths are used to produce magnets that go in everything from defense to renewable energy to EVs, electric vehicles, etc. And that is a strategic asset. So what you see in the US doing now is investing a considerable amount to shore up their supply chain and ultimately produce the manufacturing facilities that can produce these magnets, so they don't have to rely on China, because that's where the bulk of the supplies at the moment. And if you look at the defense industries within the States, if it's Raytheon, if it's Northrop Grumman, they are very strategic assets. And the backlogs at these companies, just like the aircraft manufacturers, is very, very large. So it's a very defensive business model in itself. So that's definitely on the horizon or within our investment universe. And we would invest there if the opportunity arises.
Since you're like, I don't know, since you're like, so you say the S&P, the American index, has outperformed the JC 4.5%
In rands.
in range, but that's since 95.
Correct.
If you're looking from 2016, 2015, it must have outperformed 20%.
Even more so.
Just from that, in the last 10 years.
Yeah.
So, okay, this one is obviously got the one that section 28 where you are obliged to be invested
Yes,
regularly.
55%. Yeah.
Yes,
But if you take that apart, does it make even any sense to be invested in the JSE since that?
Well,
Does it still make sense?
that is the big question, and we advocate, if the money is not landlocked to South Africa,
Yes.
either through your pension fund or
Yes,
a trust, which
correct.
cannot take it offshore, then get as much of money offshore. Obviously, it depends on each and every person in their unique circumstances, but we advocate for maximum offshore exposure.
Yeah.
If you look at South Africa, as a percentage of the global markets, it's less than 1%. It's been, well documented. And yet some people will still have 40, 50% of the assets plus in South Africa.
Yeah.
We think offshore is best. That said, that chart can be a bit misleading, because if you were to replace the S&P 500 with any other developed index, it does not look as positive. So that is
So the Euro stocks or the English,
the UK, all of those.
It doesn't look so good.
Not as good. It's the US has been
Make us look bad.
correct. US, especially after the past 10 years, has just been a market sector.
And you think you're not a magician, but you think you're at the top. I mean, it can't carry on like that. Shoot.
Look,
Wow.
I think this degree of outperformance will be difficult to match going forward. However, our models are indicating that the Magnificent Seven, which have largely driven that performance, still offer significant upside from these levels. Tomorrow night will be a big test of that model with NVIDIA reporting, but we believe it can continue. Yeah.
I mean, the operational metrics for these companies are just unbelievable. And the barriers to entry to challenge the likes of Microsoft, Apple, Google is just enormous. I mean, we sort of have a phrase
So you can't have a small competitor going in against.
It's very, very difficult. They have such enormous cash piles. They understand the regulatory environments. We have a saying we've adopted here that regulation is the friend of the incumbent. So the regulation actually helps the big tech players by making it difficult for other people to compete. They've generated these enormous competitive advantages by sort of playing outside the lines a little bit, and then paying the necessary fines. But to do that, by doing that, they've amassed an enormous amount of data, a huge competitive advantage, and we believe that competitive advantage will
And Stefan, I remember also that although it's US listed, we always make this point. Most of the companies that we are invested in, by and large, have global operations. So if you are invested in Apple, Amazon, Microsoft, whatever, clearly the US is a very important market for them, but that's not the only place they operate in. They are global businesses. And so,
they listed in the
they're
US.
listed in the US, but their revenue is generated on a global scenario.
So it's not called AMD.
AMD, yes.
AMD, are they competitors to NVIDIA?
Absolutely. I think they're looking to compete, and they've actually sort of started to compete far faster than anyone thought they would. Their newest chip, the NVIDIA's is the H100. It's the M100. They brought it to market, I think, about 6 to 12 months faster than anyone thought they could. They're expected to generate around sort of $2 to $4 billion of revenue this year. And at the moment, the tests sort of say that NVIDIA is still very much superior in terms of processing power. The real sort of incredible effects of creating a fast processor is it then enables you to create a faster one. So it's an iterative process which compounds, because to create a processor, essentially you are on a nanometer level creating links between these gates. And the faster your chip, the more simulations you can run to create a faster chip. And that just builds on itself. And so NVIDIA has a massive advantage, one in the hardware space, but two in the software space. So their CUDA platform enables software developers to customize chips based on their particular need. And that platform they've been building for the last 20 years. So we do hold NVIDIA and AMD in Wealth Warriors. Differing weights, AMD significantly lower at around sort of 4%, because we believe that, particularly at the moment, supply is very constrained. So you have your top players who are buying the top chips. Your sort of slightly sort of smaller companies, they're still going to need chips. They can't get NVIDIA chips. Where they're going to go? They're going to go to AMD. So we believe you can play the market in, well, more than one way for sure.
Now, do we believe AI is just a fad? We don't, not at all. If you look at the order book with NVIDIA, they probably sold out 18 months in advance. When the company's CEO guided on revenue for the following quarter, he gave a number. I think it was a 50% growth for the quarter year on year. However, he even was that confident to give a range. It will be within a range of for the 2% either side. So they are sold out and can't make these things quick enough.
Yeah, for 18 months. I mean, yeah, just to speak on why AI is not a fad. I mean, we've had two of the sort of titans of the tech industry, Bill Gates, obviously for Microsoft. He says AI is or ChatGPT rather, is the single most impressive technological advancement we've seen, or he's seen, since the graphical user interface. So essentially, rather than coding, you have a screen which you can move your mouse. That obviously jumps personal computing at enormous levels. It's the most impressive thing he's seen since the introduction of that technology. Sundar Pichai, the Alphabet CEO, said he believes this is the single most important technological discovery humanity has ever discovered, more so than fire, more so than anything we've seen before. So I think to have the caliber of people speaking so highly about it just shows where they believe this technology will go. And I think, you know, we can see in the download sort of rates of these apps, you know, every single year it takes fewer and fewer days for these apps to reach 100 million users. I can't remember the numbers off my top of my head, but, you know, Facebook took X amount of days, Instagram took fewer, ChatGPT reached 100 million in about a week. And it's because everything is so distributable, it's so accessible, and it will be very, very, it won't be too long, I believe, until we have AI integrated in every single bit of our daily lives. And to process that, you need NVIDIA GPUs, you need the software and the hardware behind it. So it's very, very exciting. It's just the start of something really world changing.
So I think we're all in agreement with the potential of AI and the use cases. And you can see that in what's happening between the US and China, with the US seeking to put export bans on this equipment going into China, because it does have a downside as well. Not everything is only used for positive. It can have nefarious reasons as well. The threat is of these chips being used in defense equipment, bombs, drones, etc., and that's a huge risk going forward. So we believe that the regulation is going to pick up both on a national level, but also on a regional level within countries. If you look at the negative effects that social media has had over the past 10, 15, 20 years, you take what social media has done and then you multiply it by a factor determined by the increasing processing power that is now available with these chips. It can be used for very, very nefarious reasons. So regulation is going to increase, but as Charlie said, regulation is the friend of the incumbent. Once you're in there, then you put the wall up, and they are the ones actually lobbying for regulation on AI at the moment. It's these existing players.
It's a real irony. And I mean, to build on the threats, another theme we're very heavily invested in Wealth Warriors is cybersecurity. So Ross mentioned how AI can be used for sort of good and evil. Some subsequent effects of AI we've seen in the last 12 months is an increase in cybercrime. Cybercrime is rampant. JP Morgan the other day said they experience 45 billion hacking attempts every single day, which it's a mind-blowing number. The average cost of cybercrime in 2023 in the States was, I think, $9.5 million. And that is in terms of your actual business loss. It's in terms of lack of customer confidence. We've got a chart in our Wealth Warriors presentation, which I invite you to join on Thursday, talking to the growing cost of cybercrime worldwide, and it is in the tens of trillions of dollars in the next 5 years. For some context, I think the US economy today is 22 trillion. So they're expecting an entire US economy's worth of money to be lost through cybercrime by, I think, 2027. So, just as you've got the tools, people use them for good and bad, but it's important to cover, the good actors who are responsibly but profitably making use of this technology, but also the safeguards in place who stop it. Choppy mentioned CrowdStrike. Very proponents of that company.
Yeah, so I don't think your average retirement fund, to your point, I think as people near retirement, near the need to start withdrawing on their capital, it is prudent to balance their portfolio with something less volatile.
Max, are you listening?
It's to balance.
I was at that league. But Ross, just to add to that value versus growth, I think important point, Carl, is our Rand hedge component is by nature quite defensive, with the likes of Bidcorp and Anheuser-Busch. Just that sort of Rand hedge universe tends to be slightly more defensive companies. So in terms of that value growth tilt, it is naturally tilted back towards more sort of neutral bias because of that offshore, the Rand hedge components. It's quite a good little balance.
And sorry, and quick one. And your renewable, do you believe in that or not? Those renewable energy, are they still actual or not?
So we are invested in a company called MP Materials, not quite renewable.
Yeah.
We have had a look into the various solar plans and renewable energy types.
Do you think there's growth into that or?
Solar panels not. It's
No.
becoming a bit of a commoditized product.
Exactly.
Prices are just trending down as more produced. But of course there's growth there given where it's sort of.
But this is not what we don't.
We have exposure to sort of the raw materials,
Yes.
which is used in the electrification of vehicles, etc. But that's sort of indirect.
The lithium, what are those?
Near lithium precious. That's a bit easier.
To Charlie's point earlier, not all themes are investable for us. So we really like that as a theme. However, the sort of the moats and the business models within that theme, we yet to find one in which we can invest.